Good morning, everybody. My name is Simon Nicholas, my partner here at KPMG in the Isle of Man, and welcome back to week 3 of our Preparing for a New Reality series. And we really appreciate you coming back to join us. I guess welcome to July. I can't believe we're in July already. I hope you had a good week. And as we touched on last week, we're beginning to see some form of normality return to certainly our island. And it's quite novel to start the meeting people again for coffees. I think I've got my first business lunch today, which I'm looking forward to. But we're definitely starting to see that mix of people continuing to work from home and those that are slowly coming back to the office. And KPMG is definitely matching that trend as people are slowly starting to come back in. Our session today is pretty packed with some great topical subjects. So you'll be thankful to hear that you'll hear a little bit less from me this morning, and I'll give the airtime to our great guests that join me today. This morning I'm joined in the room by Rebecca Cretney of Nedbank Private Wealth here on the Isle of Man, and she'll be bringing us an update on current markets and a take over the I guess what will happen, what she thinks will happen in the next 12 months. But before Rebecca presents to us, I'm really pleased to be joined by my colleagues, Ben Blair and Jodie McTaggart from the Cayman Islands. It is pre-recorded whilst we're all adapting to technology. We weren't quite brave enough to do a transatlantic live webinar yet, but possibly we'll come to that. But they'll be talking us through and giving us some background around ESG, which is definitely a growing topic, and talk through some of the research that KPMG have done around this. That's definitely an area that hasn't been that spoken about a great deal on the Isle of Man, but in some of our other islands and some of the broader markets, it's talked about a lot more. So I think it will be a key topic for the Isle of Man going forward. And of course, we've got the unique biosphere accreditation, which I think will stand the island in good stead in this topic. But I guess I'll pass over to you, Ben.
Thanks, Simon. So I think first off, let's just quickly define what ESG is. So ESG stands for environmental, social, and governance. And a set of standards that people are using or criteria for a company's operations that socially conscious investors are starting to use to screen potential investments. So environmental criteria, they look at how the company performs and is a steward for nature. So looking at companies' waste, pollution, carbon emissions, and treatment of animals. Then you've got social criteria, where they're really examining those relationships between stakeholders. And then governance, deals with the company's leadership, the executive pay, internal controls, shareholder rights, and audits. And I think they're the base levels of looking at ESG. And then further developments and investment strategies are really around sustainable investing, which goes one step further, where it looks at ESG criteria and then making investments based on specific ethical guidelines. And typically that might be using ESG factors as negative or positive screens in that. And then lastly, there's impact investing. And impacting investing is where you're really looking for a positive outcome. And that's the main reason why you're doing that investment in the first place. And with this, KPMG have recently released a report, Sustainable Investing, fast forwarding its evolution. And what we've really seen is in the last decade, various governments worldwide have enacted over 500 new measures to promote ESG factors. And given the magnitude of the task and the amount of players that are involved, this is including governments, regulators, the capital markets, business and consumers. And they're starting to be aided and abetted by green technologies and business model innovations. Institutional investors are really the key drivers behind the sustainable investing. They're really the early advocates in the markets. I think 84% of our managers who were surveyed indicated the institutional investor as being the biggest drivers for the demand. And I think this is interesting just for an investment managers industry perspective, because typically in the past, investment managers have come up with solutions and products and then sold them. And this is really the start of something new where the investors are really driving the products and what they want. And so KPMG International, alongside Create Research, AIMA, and Kaya, undertook a report to examine in detail sustainable investing and its impact on the alternative investment industry. And the research included insights from over 135 institutional investors, hedge fund managers, long-only managers, and pension consultants in 13 countries in all the key regions. And I think the research highlights 3 key areas on the lessons learned, and these are on what's the current state, what's the impact and the pace, the impact of the barriers and the pace of the progress, and then lastly, the evolving best practices that people can undertake to further their journey. I think what's interesting is that not all ESG concepts are new, and previously, before the ESG terminology, these factors were just known as quality inputs, and these were embedded in processes for over a decade. And so 63% of managers cite the lack of data as being the largest problem when it comes to further integration and adoption of ESG. And I suppose at the heart of sustainability sit 3 foundational concepts that have been proved hard to quantify. The first is materiality, those factors underpinning performance and risk. Secondly, intentionality. Is a company really intent on doing good? And lastly, additionality. Does it generate benefits for society as well as economic benefits? And I think so far, each of these areas have really relied on blending existing data with a lot of judgment calls. And there's over, I think, roughly 150 different major data vendors, each with their own proprietary definitions and methodologies, where they're basically having radically different assessments of the same companies. And some see this as becoming the Achilles heel for sustainability industry. In our research, we've really identified four key areas for best practice: greenwashing, industry codes, improving ESG reporting, and lastly, active ownership. And I think it's important to acknowledge that best practice is a moving target. It's continually changing. There isn't one set approach that's going to work for everyone. And there are a number of challenges that need to be overcome. And I think this is really going to work with patience, persistence, and diligence. So moving on to this last slide. So when sustainability is embedded at the core of the business, it will really show it in everything that they do, and especially able to easily communicate and demonstrate to the institutional investors and other investors in their due diligence phase that this isn't about greenwashing. This is about what they believe is their sustainability or ESG message. And so we do know there's this balancing act at the moment in the markets with short-term capital gains requirement and long-term thought process. So we do know that obviously leaders do have to have a vision and take a longer-term view, looking at where the industry is going, not where it has just been. And I think really they're the key points that I really wanted to cover in our report in this presentation today. And now I'd like to hand over to Jodie McTaggart, who's going to just talk to us about KPMG Impact and how we're transitioning to meet the needs.
Hello to all our listeners. My name is Jodie McTaggart. I'm a manager within the advisory practice in KPMG in the Cayman Islands. And I'm also part of the KPMG Impact Network, which I'm here to talk to you about. So across the globe, whether as a consequence of the mounting pressures arising from climate change, or most recently and most importantly, the global crisis arising from the COVID-19 pandemic, everybody is really having to rethink the way in which they live, they work, and they socialize. And with these challenges have come some real opportunities to think about doing things differently. And in response to this, we've reorganized our people and networks around 5 key propositions, which we call KPMG Impact. And KPMG Impact has been established to help governments and businesses develop new business models and ways of working which are necessary for their future success and longevity. And KPMG Impact encompasses 5 key focus areas. The first being ESG and sustainability. There's a wide variety of terminology and views about what ESG means. And if you ask 2 people the same question, you may get very, very vast different responses. And so we can really help you articulate and think through what ESG means to you and means to your business, understand and challenge your overall financial and sustainability ambitions, identify material issues and risks and opportunities, and communicate your strategy and your vision both internally and externally. The second is economic and social development. So working shoulder to shoulder with you to measure impact and enable societies to grow in a more equitable way by reducing vulnerabilities and allowing economies to prosper. Third is sustainable finance, and that's integrating ESG measurements into responsible investment, into financing, insurance, corporate strategies, and processes. Fourth is climate change and decarbonization, really driving business models, products, and services that address climate change and help clients to reduce their carbon emissions. Governments and stakeholders are really pushing businesses at this point to reduce their own emissions through regulatory changes, investment decisions, and purchasing choices, and really the time to act is now. And then fifth and finally, impact measurement, assurance, and reporting. So enabling you to devise improved methods, tools, and frameworks to better track and measure the performance. So we really see these 5 focus areas as growing areas. They're here to stay. They're not just a fad. And we really encourage listeners to reach out to your relevant KPMG contacts to start the conversation and learn more about how KPMG Impact can help you to drive purposeful growth in your business.
Guys, thanks very much for your presentations. That was really, really interesting. I must say, like many people listening to this today, I suspect they don't know enough at the moment about ESG. And I think, like you touched on, ESG means different things to different people. You know, the theme today is around investments and investment markets. I mean, Ben, what are you seeing with ESG investments? Are they performing better than the average? I mean, if there is any good performers at the moment?
Yeah, I think there's been quite a lot of increased literature into this area since COVID-19, looking at the outflows and inflows into the markets. I think Morningstar have done an analysis of it, and there's been significant outflows of normal performing, like normal categorized funds, whilst actually over this time there's been net inflows into ESG orientated funds. So I think that's really indicating how investors are starting to view ESG at this time. That's probably, some of that might just be from a sort of a purely risk perspective. If you think about, you know, some key ESG factors, for example, around air travels, oil companies, cruise ships, tobacco, these are, you know, bad ESG scores and factors. And at this time in COVID and all the lockdowns globally, those shares have been performing poorly. And so I think probably a lot of it now is from a risk management perspective, not necessarily from a performance related, but I'm sure we'll be able to, you know, in a couple of months, in half a year, they'll have more analysis on actually the overall performance compared to market. But I imagine that it's positive, and that's the reason why people are going into it.
Yeah, and you touched on oil companies there. You know, for those that have been reading the financial press over the last few days and week or so, it's oil company reporting time. So BP have just taken a massive write down in their investments. Shell's was yesterday, I think it was 22 billion of write down. Some of that COVID, some of that is just the expectation of an overall reduction in the demand for oil, be it electric cars or other renewable technologies. Of course, combined with the fact that they've made public promises around how they will be carbon neutral by, say, 2050, for example. I mean, how do you define what is, and you touched on data, but how do you really define what is an ESG investment? You know, Shell has made that promise. Does that make them an ESG investment? Yeah,
it's a really interesting question, because I think the first thing that anyone needs to do is they start on, you know, their ESG journey or sustainable investing journey is really to define what it means to themselves. You know, you may have someone in the same organization, both sitting next to each other, and both have completely different narratives of what it means to them. So I think what you really need to do is go along, work out what your fundamentals will be for your investing decisions. And once you've done that, then you can go out and look, and, you know, once you've integrated those thoughts into your framework, you can then go along and look at what positions will work for you and what you want to go into. You know, I have heard big global asset managers who focus on ESG, and sometimes they buy positions and investments where the ESG factor scores can be low, but they've looked at those underlying fundamentals and they're seeing that actually, look, it does work, and we do think this is a good ESG investment, and they'll make that decision. So I think it really is about what it means to you and about how you measure it to be how you do your investment thesis.
And you touched on governments and regulators getting more and more involved. I mean, is it not ultimately their job to help the markets and define that?
Yeah, and I've been to some conferences where this has actually come up as a discussion point. Is it the regulators or is it the investment managers to really drive the behaviors? And I think it's a fine line, but the governments are making decisions based on carbon emissions, and therefore, as you've already mentioned, like obviously they are having big oil companies writing off all effectively stranded assets. They're not going to be having the same sort of returns in the future for what they've spent to date. So regardless if the regulators need to push it through, if the cost of renewables becomes cheaper over time, which all indicators at the moment that has been happening, then there'll become a point where it is cheaper to do than oil, for example, and then you'll have those assets in the oil companies being written off more. And so I think like, as going back to the original part of the question, like the regulators are going to change some things to what they want to do, but it's up to the investment managers really to consider those long-term factors and how they may impact now.
Yeah. And can you see a day where regulators or governments might insist that X percentage of investment funds have to be invested in ESG? Do you think they will take control in that way to push that change through the corporate world?
The European Union's recently introduced the TCFDs, and that's really about disclosing around the carbon emissions.
Yeah.
And so I think it's going to continue like that. I'm not sure they're ever going to get to a stage of mandating anything. I think the US is really interesting. I think speaking to a number of US managers, they're not sure it will ever be mandated at a federal level. However, they think that the actions that will be taken in the US will really be at the state level. You've already got sort of, for example, California already having carbon taxes, and those instruments that come off that. And so I think that's really how, maybe regulators will, in different areas, and especially in the US, they'll get sort of further along in this. And I hope that market forces will then be the ones to shift how the allocations work.
Yeah. And Jody, obviously it's great timing for KPMG to sort of refocus itself into KPMG Impact, and it is great timing. I mean, what's really interesting from my point of view is 2 weeks ago on when we kicked off this webinar series around the new reality, we were able to share various different data around how employees and customers are going to expect the businesses they interact with to have their ESG strategies to be environmentally friendly, if you like. For many businesses, I suspect on listening today, they may not have even started that journey yet. It's quite overwhelming, I think, for me, even as a professional. So what advice have you got for them to think about?
I'd start by saying that you're integrating ESG into your business it's really a journey and a transition rather than an immediate outcome. And I think it's a journey that's really going to take you through 3 distinct phases of defining, as Ben mentioned, integrating and then reporting. And it's often that first phase that may seem like the most difficult one, sifting through all the noise and information that's out there and really defining what ESG means to your business is the key step. Defining your beliefs and your ambitions and ultimately what success looks like for your organization. And then determining where to play and kind of what strategic options are available to create the most value for your business. And then developing a clear roadmap to get there. And I'd also end by saying it's really not a journey that you have to take alone. And we and other organizations are here to help you along the way should you need it. regardless of what stage you're at in the process.
Yeah, yeah. I mean, clearly, with Blue Planet was big, and we saw corporates just suddenly dropping plastic cups and the likes of these different things. But ESG really is a lot more than that, though, right?
Absolutely, absolutely. It's really about integrating it into every aspect of your business, from compliance and to governance and also the reporting side of it. It's not just a check the box exercise. It's really top down and bottom up approach. To get it right.
Yeah, yeah. And obviously you guys are based in Cayman, and again, small island like us, really, here in the Isle of Man. What's the engagement been like in Cayman and your side of the pond?
I think it's been amazing, really. Especially with the pandemic that we're in, we've really seen government and private entities really working together to kind of look at the future of what business looks like here in Cayman. And as you said, we're an island, and so part of that is really working to try and protect our natural resources, and what we're going to do from a tourism perspective looking forward.
Yeah. Listen, guys, thanks so much for that. It's really, really informative. It's becoming a bit of a theme now, but we're asking each presenter, what new reality means for them. This is the new reality series. I think when it comes to ESG, the thing that really impacted me during COVID, and hopefully leads to a new reality, is just that imagery of the pollution map over China, and how the shutdown of the factories really did sort of repair the planet to some extent. And I really hope that as part of the new reality, that's front of mind for lots of people. What does it mean for you guys?
Yeah, and I think the new reality will be interesting, especially for ESG. I've mentioned that originally people were going into this to drive returns, and now really a bit of discussions around the risk management aspect of it, and it being something different and a good aspect of it. And so I really hope that what happens from this is that we're able to learn a lot of lessons about for the markets, and about how ESG actually does help drive returns for investors, and is a good thing to keep in your portfolio. I know that from my perspective, over this time, I've changed my personal investments, and I've started investing to eat more ESG orientated funds.
Yeah, fantastic. And Jodie?
And I think me kind of just taking a step back and looking at where we sit in this island nation and Isle of Man as well. Just looking forward, hoping that businesses, no matter how big or small, are doing their part to really protect and enhance the biodiversity in our countries, and to protect what we have going forward.
Great. All right, guys, thanks so much. As mentioned earlier, I'm delighted to be joined by Rebecca Cretney of Nedbank Private Wealth, who's going to be providing us with a market update, followed by a Q&A. So if you do have any questions, please do feel free to submit them through the portal on the right-hand side. Again, if you can't see it, click on the three red dots. But also, Rebecca's very kindly offered to send some written answers to any questions if we don't have time. Either email me or my team, or webinars@kpmg.co.im, and we will get the answers back to you. But I guess over to you, Rebecca.
Yeah, thank you very much for having me, Simon. It was very interesting to hear your team talking about ESG. ESG is actually crucially important. It has to do with the way that you invest, and to do with ensuring that your portfolio is consistent with your beliefs. I've actually listened to quite a few of your webinars, and I've thoroughly enjoyed them. So thank you for having me. It's a real pleasure to be here today. The brief that your marketing team gave me was to talk about whether now is the time to invest, or whether it is time to run for the hills. Now, this was a very cleverly framed question, and I strongly suspect that You knew it when you asked it. When people ask, is now the right time to invest? What they usually mean is, what are the stock markets going to do over the next 12 to 24 months? But is now the right time to invest is actually a far better question than what's the stock market going to do over the next 12 months. So although I'll provide you with our market outlook, I will first ask your listeners some questions. And I acknowledge that some of these are a little bit unfair because they require a level of expertise to answer them, even if they might initially appear straightforward. So the questions are, why do you want to invest? What are your objectives, and what happens if you don't achieve your objectives? When do you need the money by? How much of your wealth are you looking to invest? For who are you investing? How much risk do you estimate that you need to take to meet your objective? How much risk can you afford to take to meet your objective? The answer to the question, is now the right time to invest, will inevitably be informed by the answers to all of those questions. Because the answer to what's the stock market going to do over the next 12 months is an educated guess based on a set of data, statistics, and assumptions. I'm not an economist, although my job involves economics. I'm not a market analyst, although my job involves analysis, and I work very closely with both economists and market analysts. My expertise lies in advising clients on the right strategy to meet the objectives shaped by the answers to those questions that you see on screen with a certain amount of probability. So as I go into the market analysis that will follow, I'll ask listeners to bear in mind their specific investment requirements and goals. Because ultimately, I can't answer the question, is now the right time to invest for you? So allow me to try and answer the question relating to the short-term outlook for stocks. I should caveat here that at Nedbank Private Wealth, we would more often than not adopt a multi-asset global approach for clients, including not only stocks, but also property, bonds, and alternatives. But we only have 15 minutes, so I'll focus on the question at hand. It's big enough, which is stock markets. And I'll try to make sense of what appears to be a stark divergence between the level of bad news out there and stock markets. The International Monetary Fund anticipates that the global economy will shrink by 4.9% in what will be the worst recession since the Great Depression. And now you see on screen there are April projections alongside June projections, which is the revised data that the IMF gave towards the back end of last week. As you can see in the chart, according to the IMF, advanced world economies will fare the worst, with a contraction in their GDP of 8%. But although this information isn't in the graph, in the top 5 greatest hits to GDP, we find the UK, with a GDP contraction of 10.2% anticipated. The IMF's numbers assume that financial conditions will remain broadly at current levels. It doesn't factor in the possibility of another set of lockdowns as stringent as the ones that we're coming out of. Emerging markets, as you can see, are anticipated to fare significantly better. In aggregate, their economies are anticipated to shrink by 3%. So what are the consequences of all of this? How on earth have we survived? Via an eye-watering amount of debt. Here we can see the debt levels for advanced economies versus emerging markets. And as you can tell, we are reaching debt levels as a percentage of GDP that surpass the post-World War II peak. So now that we've looked at GDP projections, let's take a look at corporate earnings. Before I talk about the information that you can see on screen, which is specific to the US, let me give you our global projections. Overall, corporate earnings are likely to fall around 30% in 2020. But this is not the same across all sectors or across all company sizes. There's a significant divergence between the performance of big and small companies, and those that are most susceptible to COVID-19, such as airlines, for example. Big companies with strong balance sheets and dependable earnings can borrow easily at cheap rates due to the vast amount of fiscal stimulus out there. Small businesses, which are responsible for a large proportion of GDP and employ a lot of people in the developed world, will struggle. They have limited resources, often large payrolls, and not many capital buffers. There could be high levels of unemployment and high reliance on the welfare system. If a second wave of infections can be avoided, earnings for companies that weather the storm should rebound to more normal levels by 2022. But I would like to use the information on screen to illustrate the divergence in earnings by sector, as well as by company size, which I've spoken about before. And to do so, I've chosen the S&P 500 estimates because the US is the largest market. As you can see, these graphs are isolated by sectors to highlight the stark differences between these. On the top right-hand side of your screen, you can see that we have lumped together industrials, energy, consumer discretionary, and financials. And the earnings in these sectors are anticipated to be lower by about 50% this year, and only to recover in 2022. Information technology, on the other hand, which is just below that, has suffered no notable change at all in earnings. And there's a substantial increase in earnings over 2021 and 2022. While analysts expect overall earnings to return to last year's levels in 2021, this is mainly because of the technology and the healthcare sectors, which are the two biggest sectors in the S&P 500 by market capitalization. Outside of those two sectors, earnings per share in 2021, or corporate earnings, are expected to be down 8.6% from 2019 levels. So if the situation is as dire as the bad news that we are hearing, why have markets done this? The graph shows the MSCI All Countries World Index, which is a broad measure of global equities as a whole, using the largest 2,700 stocks from 47 countries across the globe. But if looking at world markets, you think that they are disconnected from economic reality, just take a look at the US market. US markets aren't far off where they started at the beginning of the year. For comparison, I've included emerging markets here, which is the yellow line, and the bond markets, which regained support after the Fed backed them. There are two indicators that historically have moved in the same direction. This is consumer confidence, which is the green line on your screen, and the stock markets, which is the red line on your screen. And as you can see, they've historically trended together. But recently, they've become disconnected. They're going in completely different directions. The stock market is going up, and consumer confidence is going down. This inevitably raises questions about the rally's sustainability if it weren't for the boost provided by central banks. So what then is the shape of the recovery? You will have no doubt heard of analysts talking about a veritable alphabet soup of options from V to U to W to L? I suggest that the answer should probably be that this is very much region and sector specific. Although broadly this might look like a V or a W, as we saw in the earnings estimates by sector before, some sectors have no earnings recovery to speak of. A number of developments could trigger a decline in share prices and bring us to that W scenario. The recession could be deeper and longer than currently anticipated by investors. There could be a second wave of infections with associated containment measures. We are already seeing bankruptcies, significant unemployment levels, and a widening gap between the real economy, which is bars, restaurants, and small retailers, and markets, such as the S&P 500 or the FTSE 100 in the UK, for example. Then there are geopolitical tensions. Let's not forget that we've got a trade war, not only between the US and China, but potentially about to encompass Europe as well, and a US election looming, among other risks. There's broadening social unrest in response to rising global inequality, and this also could lead to a reversal in investor sentiment. Finally, expectations about the extent of central bank support could turn out to be way too optimistic. If the support gets turned off, if that tap gets shut too quickly, things could turn nasty very fast. But there's never a comfortable time to invest. We have clients who have been waiting to go into the market for years, convinced that a sell-off is imminent, but not making use of the opportunities when they arise because they feel that things are going to get far worse before they get better. So let's ask the inevitable next question for your listeners who might have been waiting in cash for a long time. Could equities continue to plow higher? Yes, they could. Although this is not our base case, let's take a look at some of the reasons why a sell-off might not happen and why markets continue to move either sideways or indeed to plow higher. First, the increases in stock markets are not universal. As we've seen, some sectors are more expensive than others. It's no secret that cyclical stocks have significantly underperformed defensive equities. By cyclical stocks, I mean those luxury products that you tend to invest in when you feel flush, and the defensive equities would be things like Unilever. You always tend to buy washing powder, regardless of whether there's a crisis going on, or at least let's hope so. We looked at the difference in sectors across the US market before, but it's noteworthy that the average stock remains at around 75% of its value in August 2018, at that point in the August 2018 high, and I bet not very many people know that. The equity risk premium is elevated. That's the second reason why stocks could continue to go higher. What's the equity risk premium? It's the difference in the return expected from equities over what people perceive to be a risk-free rate, something like government bonds. In other words, people are plowing into equities because the return from bonds is close to zero, or in some instances, it's actually below zero. There simply aren't very many other places at all where people can hope to obtain a return, so the money goes into equities. The third reason is that if you look at an aggregate of valuations, equity valuations, investor leverage, cash sitting on the sidelines, investor sentiment, and the supply of equities, all of which are indicators of the level of speculation present in markets, the sum is at its lowest level since the 2011 sell-off. There is a wall of cash out there, and most is making its way into equity markets at a time in which equities are at very limited supply. So there's the classic supply and demand pull. There are very few initial startups coming onto the markets, and companies are actively buying back their own shares. Given the massive fiscal injections, as well as the extraordinarily accommodative monetary policy around the world, it's possible that if an equity sell-off occurs, it could be limited. Additionally, here we've only considered the US equities because they're the most expensive and what the financial press tend to focus on. They grab headlines, but UK, European, and emerging market equities are nowhere near to being close to their previous highs. Finally, I've given you lots of objective reasons why markets might go up and why they might go down, but there are also behavioral biases to consider. Investors want prices to go up. Traders want prices to go up. Trump wants prices to go up. The Fed wants prices to go up, and I could go on. But before I conclude, forgive me a little bit of an analogy. We're told that the coronavirus affects people with pre-existing medical conditions more severely, and therefore we classify them as vulnerable. In the same way, it has affected countries differently. Societies and cultures where there were underlying divisions and cracks now see endemic national issues appearing. Countries such as the US or the UK have seen divisions exacerbated, while other countries have actually grown closer together. Bizarrely, this is the case for Italy, or more widely, the European Union, for example. I was very interested to listen to your recent webinar in which you hosted Alf Cannon. He spoke about how sentiment changes from doom to optimism. And I think this is the duality that we are seeing here in the disconnect between markets and economies. We've never seen a recession brought about as a result of a health scare. In the past, we just kept on going. We even covered up pandemics. This recession is entirely self-induced. We have willingly stepped into it in order to protect lives and to protect the NHS. The Black Death destroyed a third of the European population. But what followed? Flourishing Italian literature, the Renaissance, the printing press, the world responded positively to a trauma. In 1918, we had the Spanish flu. And now I have to say that having been born and raised in Spain, this name annoys me intensely. It should be called the Kansas flu, because that's where it originated. It was only the Spaniards who actually called it out and said there's actually an epidemic going around people. But it killed hundreds of millions of people worldwide. But then what happened afterwards? Then came the roaring 20s in the US, the stock market boom, the introduction of electricity, the radio. So you see people reacting in a very positive way. Both of these scenarios evidence how people react to adversity in the same way as a tree does when you prune it. What happens? It gives you more fruit. We will also flourish and we will grow through this. But the fruit of the pruning might not be seen for a few years. In speaking to many local Isle of Man firms, I've often heard, it has forced us to push through changes we were already considering. The speed of change, which was deemed necessary pre-pandemic, is accelerating. Changes to the way we do business in order to protect the environment are happening faster than Greta Thunberg ever thought possible. Ways in which we communicate with clients are changing. Overheads, such as the need for beautiful office space like the one that you've got here, or business travel are coming under scrutiny. So as investors, this accelerated rate of change presents us with an opportunity for enhanced returns and cost reduction, but it also presents us with risk. The opportunity is actually to invest in companies that are using the horribleness of the pandemic as a time to morph and to change into something better. They have defined their reality. They have accepted the fact that it's not like they would like it to be. It just simply is as it is. And then they're doing something about it. They are somewhere along the path of following KPMG's 4 R's. Reaction to the pandemic, an acknowledgement that some things need to change in order to remain resilient in the short to medium term. That's two of your R's. Whether they're in the path to recovery, which is your 3rd R, or not, doesn't yet matter. As long as they've reacted, they're proving resilient, and crucially, they're examining the ways they can't just survive. No, the ways in which they can thrive. Now I hear you say that's really a bit unfair. Some companies, sectors, and indeed countries even, as we've seen, are far better equipped to deal with the new reality. Spot on. And some companies will fail. The cracks will become deeper. And that is the added risk. So if you're an investor, and most of us are, at least through our pensions, and you don't carefully monitor and evaluate your portfolio, you might end up buying companies that are going through KPMG's 4R transformative process alongside those who are viewing the pandemic as a problem to their business model, but not challenging how they do business. A bit like an ostrich with their head in the sand. You might have companies who are unlikely to survive in the new environment, or you might even be investing in zombie companies propped up by cheap credit. So how often do you need to monitor your positions? Well, at Nedbank Private Wealth, we monitor our positions and the risks we take on behalf of our clients daily. We acknowledge that this might not be possible for everyone, but we suggest that in this environment, the answer should be as often as possible. So in conclusion, I go back to the start. There are many reasons why the stock market could go up, and there are many reasons why the stock market could go down. And there are ways to mitigate these risks. But the key is to establish whether now is the right time to invest for you. And for that, you need a plan. Trying to time the markets has been proven time and time again to be more often than not the wrong decision, especially as markets are rising 80% of the time. There is no single universal answer to the question, is now the right time to invest? And there's certainly no single universal answer to what that investment should look like in order to meet your short, medium, and long-term goals. So that's it for me. Over to you, Simon.
Rebecca, thanks so much. I can see, obviously, most people are listening, but they can't see how passionate you are about this subject. And clearly, I think I could certainly listen to you all day about it. I mean, I've been questioning, I think we were talking about this in the warm-up, but I've been questioning, I'm getting daily economic reports through the KPMG network and Eurasia, who we work with as well, that are painting it such a different picture. And then I go home in the evening, look at my portfolio, and think, what on earth is happening? It just doesn't match up at all. And thank you for touching on that, because that made a lot of sense to me. I'm sure our listeners would have liked it too. I mean, what are your recommendations for people that do find themselves in this situation where they've been waiting to invest, they're nervous, they're worried about this drop in stock markets? I mean, what are your thoughts on it?
Well, we've got quite a lot of clients in this position ourselves, actually. The answer, in short, is diversification, and to really take a very close look at your own objectives and circumstances. But to give you a more specific example, some of our clients have considered investing in a mixed portfolio of assets, where they're taking significantly less equity risk than they typically would do. So they're going in, for example, at 25% of the equity allocation that they would normally have within their portfolio, and trying to gain returns from other asset classes. This means that they've got a hedge in place. So if equities rise, they've got that 25% built into their portfolio. But similarly, if equities drop, there is a natural point at which the remaining part of the portfolio's allocation could then be deployed to buy into equities at what would be considered to be a far better time. But the key, I think, is to bear in mind what your specific long-term objectives are. Because if you were to say, well, you know, I need money in 2 years' time, I'd say forget it. Don't even think about going to the stock markets. But if you were to say, well, you know, I've got 40 years, I just wouldn't be able to sleep at night, you know, if I invested in equities and all of a sudden I saw this massive drop. Then there are ways in which portfolios can be constructed to help you sleep at night, and to still earn a positive return, so that you don't end up 5 years down the line looking at equities having plowed higher when you were waiting for that correction, or indeed having seen a correction and kicking yourself for not taking the opportunity when you had it.
Yeah, I mean, so we talked about, you know, my kids are lucky enough to have some very generous grandparents, and you know, I guess my decision on what I put them into is very different, really, to what I'm putting my own stuff in that I might need in, say, 10 years versus their 20 years. But yeah, I guess everyone's circumstances are very different, and I think it's a really good point, well made today. I mean, we touched on the S&P 500. You know, what are your thoughts around investing in Europe and the UK in particular?
Good question. Well, we've got the headwind of Brexit, which seems to have slipped a little bit from the headlines. Previously, we were quite fed up with with Brexit, but this could have a very big impact, especially on sterling. Although some of the risk of a hard Brexit has already been priced in. But to look at it from a different perspective, if you look at it from a European perspective, Europe is over this now. And trade negotiations are all about power. The small country, which in this case is the UK, unfortunately, doesn't get to make demands. There are 300 million people in the EU versus 60 million in the UK, and the EU has now shifted its sights. They're now looking firmly at Italy. Italy is a bankrupt country. Without the ECB, it would have much higher bond yields, and it also has Salvini, which you'll know is from the Northern League, in the background, stirring up dissent. So saving Italy is now the issue. What has happened is that real leaders in the EU have emerged. Angela Merkel has decided to issue joint bonds issued by the European Commission and backed by Germany and France, which is a huge change. So we're going into a new phase in the EU, and this could well be a phase that provides opportunity. The EU is moving towards a fiscal union of some sort. So the question for them isn't Brexit; it's how they help the Italians, because the Germans in particular realize that the ECB has sort of been the victim of an Italian coup d'etat. Over the last 10 years, the Italians have pretty much taken over the ECB. Since you'll recall that in 2012, Trichet left and Draghi came in, and every pivotal decision on the ECB's council has pretty much gone Italy's way, but it still presents an opportunity. In our opinion, it's a good move forward for the EU if there is this fiscal union. But the risk for the UK is still that we might crash out, and then it calls into question, what happens with the Scots, because 52% at the moment are in favour of independence. So, and we see that this could also actually pose a challenge for the Isle of Man and with conducting operations in Europe. So, there's a lot of risk associated with Brexit at the moment that it really just isn't hitting the headlines as much as it should.
Yeah. Yeah, no, quite well. I guess I can't think what stole the headlines, but that we've got quite a few CSP businesses and life businesses that are exposed to Asia. I guess I've particularly been following that as I've got friends living in Hong Kong, and what are your views on China? And obviously, well, in the sidelines of that, of course, we've got the Trump war as well.
Yeah.
What are your thoughts around investing in China? And
another good question. In China, obviously there are geopolitical tensions, which could come to the fore. Their recovery started sooner, but just as they were reopening, the rest of the world were shutting down.
Yeah.
In China, supply is recovering faster than demand, and production is greatly outpacing new orders. So the Chinese government has pledged 9 million new jobs, and you'll know that the Chinese government is the majority shareholder in a substantial amount of companies. So the key mechanisms that they will use will boost the flow of credit and fiscal spending. They have abandoned their deleveraging objective. So they were getting rid of some of their debt, and this is now stopped. You'll have seen in some of the previous graphs that the level of debt in emerging markets as a whole has risen, but nowhere near as much as it has in developed economies. And what the Chinese government are wanting to do is to drive growth directly. So there's a rebound in the construction sector, and this is outpacing manufacturing activity. It's interesting to note that infrastructure actually grew 10.9% during the month of May alone. So the Chinese government are going to spend their way out of it. And if you own commodities, this is likely to be good news for you.
Yeah. Oh, fantastic. I'm going to start to wrap up now, but we've asked each of our guests this question. I think I've got a sense of some of your thoughts around new reality, but what does new reality mean to you? And by the way, thank you for mentioning the 4 R's. That wasn't scripted. We get accused of that. But what does new reality mean for you, as both, I guess, from a web perspective and personally? What would you like to see?
I think the new reality is going through the pain of change represents opportunity, and I think this applies to people on a personal level as well as on a business level. And when you're faced with a certain level of aversion, you have a choice. Personally, companies have a choice. We all have a choice. We can decide to embrace the new reality and to change and to adapt and to morph, or we can grow all bitter and resentful, and any existing cracks that there were out there will just grow.
Yeah.
And so I think that that for investors, but for companies and for directors, etc., I think it's just having that mentality to embrace change and to say, okay, not as I'd like it to be, guaranteed, but I still really want to succeed, and I will succeed. I will make a go out of it, and I will succeed. I will change. I'll do whatever is necessary, but I will change into this new reality.
Yeah, and I completely agree with you. If the Isle of Man economy and can't be nimble enough to adapt to that change, then good luck to the larger developed countries. Well, listen, I'm afraid we've run out of time. So thanks very much to Ben and Jodie. We will get the last minute or so of the video out on the replay. But Rebecca, thank you so much for a really insightful presentation and certainly the willingness to take questions. For any questions that do come in, we will pass them on as well. So today's webinar and slides will be available on our website, so kpmg.co.im/webinars. For those that couldn't make it live, they will be on demand. But again, if you do have any questions, please do feel free to reach out to us. But I trust you have a great rest of the week, and we look forward to welcoming you back. Same time, same place next week.
Thank you very much.